Australia's biggest banks are ringing the alarm bells, and this time it's not just talk. Commonwealth Bank, Westpac, ANZ, and other major lenders have all quietly shifted their tune on the housing market, and what they're now saying should worry every homeowner, every renter, and every hopeful first-time buyer across the country. For years we were told property only goes up. Now the very institutions that fund most of Australia's mortgages are warning that the golden run might finally be running out of road. If you own a home, if you're planning to buy one, or if you simply care about where the Australian economy is heading, stick around, because what's happening right now could reshape the financial future of millions of families. Welcome back to Aussie Benefit, the channel where we break down what's really happening with money, property, and the economy here in Australia in a way that actually makes sense. If this is your first time here, do yourself a favor and hit that subscribe button, because we cover stories like this every single week, stories that mainstream news often buries or explains in confusing jargon. Today we're diving into the growing concern among major banks about the direction of Australia's housing market, why the mood has changed so dramatically in recent months, and what it could mean for property prices, mortgage holders, and anyone thinking about buying a home in the near future. This isn't fear-mongering. This is what the banks themselves are now telling their clients and investors, and it's worth paying close attention to. For most of the past couple of years, Australia's property market seemed almost unstoppable. Prices in cities like Perth surged dramatically, driven by strong population growth and a chronic shortage of available housing. Even Sydney and Melbourne, despite being some of the most expensive cities in the world, kept climbing higher, fueled by low unemployment and steady demand. But something shifted heading into the middle of this year. The Reserve Bank of Australia raised interest rates multiple times, pushing the cash rate up significantly and unwinding much of the relief that borrowers had enjoyed the year before. Every major bank passed those increases straight on to variable rate customers, which means mortgage repayments jumped almost overnight for millions of households. On top of that, the federal budget introduced major changes to negative gearing and the capital gains tax discount, changes that experts say have hit investor confidence hard and accelerated a slowdown that was already quietly building underneath the surface. Commonwealth Bank, once one of the most optimistic voices on housing, has significantly downgraded its outlook, now expecting national price growth to be far weaker than originally forecast, with some of their economists suggesting prices could actually fall in certain segments of the market. Westpac has echoed similar concerns, predicting that average price growth across the major capital cities could stall completely for the year. Meanwhile, auction clearance rates, which measure how many homes actually sell at auction, have dropped below 50% in major cities for several weeks running, a clear sign that buyer confidence is weakening. Sydney and Melbourne appear to be leading this downturn, with some forecasts suggesting price falls of several percentage points in the coming financial year, while cities like Perth, Brisbane, and Adelaide are expected to hold up better thanks to tighter supply and continued population growth. This is what analysts are now calling a two-speed housing market, where some regions cool sharply while others remain relatively resilient. What's especially notable is that the banks aren't necessarily predicting a full-blown crash. Most are still forecasting modest growth or a flat market rather than a dramatic collapse. But the tone has clearly shifted from confident optimism to cautious concern. Rising unemployment, which recently climbed to its highest level in years, adds another layer of pressure, since job security is one of the biggest factors influencing whether people can keep up with their mortgage repayments. Economists are largely in agreement that interest rates will likely stay steady for the rest of this year, with the earliest possible rate cuts not expected until sometime next year. That means anyone currently struggling with higher repayments may need to wait longer than hoped for relief. For existing homeowners, this could mean a longer period of financial strain. For those hoping to enter the market, it could actually be an opportunity, since slower price growth and reduced competition may finally make some properties more attainable than they've been in years. It's also worth mentioning that not all types of property are being affected equally. Units and apartments appear to be holding their value far better than standalone houses in cities like Sydney and Melbourne, partly because they remain more affordable for buyers who are being squeezed by higher borrowing costs. At the same time, properties at the lower end of the price spectrum are proving more resilient than luxury homes, which tend to be hit hardest when confidence drops and buyers become more cautious. This divide highlights just how complex and uneven the current housing landscape has become. It's no longer accurate to talk about the Australian property market as one single thing, because what's happening in Perth right now looks almost nothing like what's happening in Melbourne. So what does all of this actually mean for everyday Australians? If you're a homeowner with a mortgage, it means preparing for the possibility that rates could stay elevated for a while longer and reviewing your budget accordingly. If you're a renter hoping to eventually buy, it might mean the market is finally giving you a small window of opportunity, especially in the cities where prices are cooling. And if you're an investor, the recent tax changes combined with a softer growth outlook suggest that the strategies that worked over the past few years may need to be rethought. The banks sounding the alarm doesn't mean disaster is guaranteed, but it does mean the easy, guaranteed growth era of the Australian property market may be entering a very different chapter. That's the full picture behind why major banks are suddenly sounding the alarm on Australia's housing market and what it could mean for your money moving forward. If you found this breakdown helpful, make sure you hit that subscribe button and turn on notifications, because we'll be tracking this story closely as new forecasts and rate decisions come in over the coming months. Drop a comment below and let us know, do you think this is the beginning of a real cool down or just a temporary bump in the road? Thanks for watching Aussie Benefit. Stay smart with your money, and we'll see you in the next one.